Hi, everyone. Good morning, good afternoon. Welcome to our event today. This is our first attempt at using YouTube Live, so apologies for any technical issues in advance. We will wait just a minute and let others join. Please post any questions you have in the chat box. We will get to those at the end of the event. And I think we can go ahead and get started. So today we are going to be talking about ESG trends, implications for financial advisors in 2021. A little bit about me before we get started. I'm the founder of Ethos, which is ESG software for financial advisors. Prior to starting Ethos, I worked as a consultant for large corporations doing a lot of data analysis, as well as worked for social impact organizations in the US, in Minnesota. So today we're going to do a very quick overview of ESG. You're probably pretty familiar with ESG already. And then we'll get into trends and implications, and then spend some time with questions at the end. So you're probably familiar with ESG investing already, but quick recap, it's considering environmental, social, and governance, or ESG criteria, alongside more traditional financial measures when investing. So from a universe of potential investments, ESG criteria can be negative filters, filtering out tobacco, weapons, etc. Can be along positive themes, investing for climate-related investments or supporting gender equality, for example, or for other positive values. Another way to think about ESG investing is from a spectrum of more traditional ESG investing, which on the left-hand side here looks really at those ESG criteria and is more focused on financial risk. To the right-hand side, where more direct impact investing, also under this broad umbrella of ESG investing, is more focused on specific measurable outcomes. So things like affordable housing, impact on a local community, anything that's more directly measurable. A lot of these terms are used interchangeably, from sustainable investing to socially responsible investing to ESG. And there's really a variety of ways to define it, but broadly we're looking at incorporating some specific environmental, social, and governance criteria into evaluating an investment. So in the US and also globally, ESG has grown tremendously the last decade. It's reached 17 trillion in the US in 2020. I think it's closer to 30 trillion globally. It's roughly $1 out of every $3 in the US is invested in a ESG or sustainable related investment. And it continues to grow very rapidly. So in the US, individual investors are increasingly interested in this. ESG traditionally has been more of an institutional investor area, but in the last 5-10 years, it's moved especially more into the retail investor space. So 95% of millennials are interested in sustainable investing, and 75% say it's a little bit difficult to do so. So part of what's evolving now in the space are tools and resources to help individual investors understand ESG data, use ESG data in their own investing. So we're going to spend most of our time in trends and implications. We see three major themes. There are obviously a lot of trends going on in ESG. We're going to cover some of what we see as most important for financial advisors today. And we see three themes, as I mentioned. So a torrent of data and analysis. It can be a little bit overwhelming. Urgency in addressing global challenges, things like climate change, social inequalities, and then changing client preferences. So we'll touch on all of those three. First one, this torrent of ESG data. So companies are reporting more ESG data from pressure from regulators, so new regulations in the EU, potential review of sustainability reporting in the US. The SEC has mentioned that they're going to review sustainability reporting requirements for companies in the US. And then companies are also just feeling pressure from investors, from individual investors, but also larger institutional investors to report more on their sustainability, their ESG performance. Your clients are likely seeing a lot of ESG-related news and data from the media. So things like controversies, company initiatives to become net zero, a whole variety of ESG-related initiatives that your clients are likely seeing from companies. Third-party analyses in the bottom left. So a lot of third-party organizations are doing independent analyses, and sort of explosion of these types of analyses, like As You Sow is a US organization, for example, that's just released report cards on racial justice for US companies. There are a whole variety of these analyses that are becoming more common. New funds and other financial products, and then more government agency data. Then in the middle, you have data aggregators and providers. So this is a little bit overwhelming for a lot of advisors. The aggregators can be helpful for sure. I would consider using some of the ESG data aggregators, but also define what you want to use ESG data for, because it can be very time-consuming and can be quite overwhelming. So second, increased awareness and adoption of the UN Sustainable Development Goals. 74% of individuals globally are at least aware of the SDGs as of 2019. That number is a little bit less in the US and Europe. It's highest in emerging markets, but it's likely to continue growing. If you're not familiar with the SDGs, these are a set of global goals first defined in 2015 that are becoming increasingly common as a framework for understanding the impact of an investment. So the implication, I think, for advisors is to first consider offering some investments that align with SDGs. Consider offering them as a thematic package, different combinations, for example, climate innovation or health and well-being, and consider branding these specifically to the SDGs. So showing how you're helping your clients and potential clients invest in line with the SDGs. There was significant social unrest, social issues, and ongoing push for more equality across a variety of social issues in 2020. And that's likely to continue in 2021. So right now in my hometown of Minneapolis, the trial for George Floyd is going on. So raising the profile of racial justice as one social issue. This is being raised on a few different fronts. Companies themselves are increasing their efforts to address social issues. So there was a whole slew of racial justice initiatives after the killing of George Floyd last year. There are an increasing number of ETF and mutual fund products oriented around social justice. There's an increasing amount of data and analysis. I mentioned the report from As You Sow on racial justice as one example. There are an increasing amount of social bonds, and then your investor expectations. So it's likely, if you haven't already, then you will be receiving some demand from clients, from leads about how can you help them address social issues through their portfolio. So there are a whole variety of these financial products and data that's available. So I would explore what's out there and consider how you can incorporate these into your offerings. The increased urgency of climate change is pretty clear to most investors. This graph on the chart is showing the available investments aligned to different global warming scenarios. So based on analysis by MSCI, about 85% of investable assets are aligned to a 3 degrees Celsius warming scenario. 40% are aligned to a 2-degree scenario, and 10% to a 1.5 degree scenario. And 1.5 degree scenario is what we need to mitigate the worst impacts of climate change by the end of the century. So it is, there's a rapidly narrowing universe of investable assets for your clients if they really care about climate change and about mitigating global warming. So you can either offer more concentrated portfolios with the associated risks that are with that, or you can consider other types of investable assets, so green bonds, private investments. But I would just be clear with your clients who care about climate change that this is the universe, this is the available universe, this is the reality. There is a narrowing set of potential investments if you want to invest in line with a more sustainable future. One way to find other investment opportunities that are aligned with the more sustainable future is to look outside of the only low carbon opportunities and look at other more innovative investments in related sectors. So things like electric cars, plant-based meats, green real estate, plastic alternatives, artificial intelligence for more efficient manufacturing, recycling and reuse efficiency. So there are a whole variety of other more creative investments that can still offer a good solution for your clients to have a more sustainable portfolio. So these could be integrated with a thematic or a variety of thematic portfolios around SDGs as well. I mentioned sustainability-related debt or green bonds. These are a rapidly growing area within the EU and the US especially, as well as everywhere around the world. Some of the categories you can see here, alternative energy, as you might guess, is the largest category for sustainability-related debt. But this is something to offer to your clients if you're not already. Increasing focus on biodiversity. So 2021, towards the end of the year, there will be the UN Biodiversity Conference in Kunming, China. And they will look at establishing some goals similar to the 2015 Paris Climate Accord around biodiversity. This is an increasingly concerning area for a lot of investors. A large portion of the global economy is tied to biodiversity, to deforestation or to use of land, as well as use of water. So only about 1% of company business models are actually aligned with these two SDGs, so life below water and life on land. This is according to analysis from S&P Global Trucost. 65% of company business models have at least some alignment with at least one of the SDGs, but very few are currently looking at biodiversity. We expect that to change. And there will be more opportunities to look at investing in companies that are doing more to combat deforestation or to support life below water as well. So one area, shifting to some of the client preferences, one area that is rapidly changing, this is a newer area for clients, is shareholder advocacy or engagement in their investments. Most clients and most investors are still relatively passive in their portfolio engagement. This has changed quite a bit at the institutional level. So this is a quote from Larry Fink of BlackRock, encouraging companies to better disclose their sustainability-related data. And BlackRock, as an example, has increased their number of engagements with company management teams. So they're increasing their engagement, but we also see this moving down to the retail investor level or to individual investors. There are a number of new startups, new organizations that are looking at shareholder advocacy and how to enable individual investors to engage in the companies where they're invested in. There's not a whole lot of opportunities readily available for you as an advisor right now, but I would watch for opportunities to do that. That will be one way you can differentiate with clients who care about sustainability, offering some specific opportunities to engage in shareholder advocacy. With COVID-19 and the pandemic, people have become obviously much more used to communicating remotely. So one area that is growing pretty rapidly with retail investors is remote engagement and sort of storytelling around the impact of their portfolio. Showing a client the impact of their money in measurable, clear ways, such as the equivalent number of cars removed from the road, or how gender equal is their portfolio. Things that are specific and measurable, and showing the impact of a portfolio to a client can really, again, be one way to differentiate as an advisor. Some of the screenshots you see here are some of what Ethos provides as part of our storytelling and impact reporting for clients, but there are a number of ways you can do this. The younger generations especially are interested in seeing their impact, understanding it in clear, measurable ways. And there are a variety of ways to do that. So there are many ways to integrate ESG or sustainability into your lead gen funnel. From the left-hand side on this page, we list a few of the areas where it's possible to do that, and we have a more thorough guide on this on our website, ethos.so. But a few of the ways, so starting with your SEO, for example, integrating some sustainability-related language into the keywords of your site, developing more content around ESG and sustainability. If you're on directories like XY Planning Network, for example, or other directories, it can be helpful to self-identify as ESG focused, or at least offering a sustainability-related investment. Similar with social and ads, it's fairly easy to generate a simple ad on social. I will be very targeted with that. Social media tends to be one of the less effective, less cost-effective ways to generate leads, but it's worth trying some sustainability-related ads on social. The impact assessment that you see here, this is one that Ethos offers. It's a simple questionnaire on this page, a simple questionnaire to get input from a client on the causes they care about, a client or a lead, capture their lead information, and then convert them from a lead to a client. So there are a whole variety of ways to integrate this across your lead gen funnel, but it's worth taking a close look at each of these areas. So we went through that very quickly, and I can go back and address any of those areas. But to recap, explosion of ESG data can be helpful or very overwhelming. So I would define what you want to use it for. Do you want to develop a robust measurement capability to offer your clients a really robust measurement of the impact of their portfolio? Do you want to just keep your finger on what's happening on ESG? Do you want to use a third-party aggregator to understand the data, to research? That'll help you define what you need to use it for, and then how much time and energy to spend actually monitoring ESG data, because there is really a torrent of ESG data coming. Second, integrating sustainability and social causes in your offerings. For example, in line with the UN SDGs, I would consider having some themes, so thematic portfolio offerings, for example, or some sustainability-related branding to your offerings to show clients, here's how they can plug into specific causes, for example, racial justice or health and well-being, thematic portfolio, or climate-focused, biodiversity-focused. As there's more awareness of the SDGs and of these causes, I think this is only going to build as a more important differentiator for advisors. Third, consider assets such as green bonds and more innovative sustainability equities. So apart from more climate-focused or carbon-focused investments, there are things like plant-based meats, electric cars, clean energy, artificial intelligence, a whole variety of things that are not specifically low carbon, but can still offer ways for your clients to engage in sustainability. Fourth, adjust your engagement approach. So client preferences, especially among millennials, are changing. They want to see more measurable impact, and also want to communicate remotely. And then last, so integrating impact across your lead gen funnel. We just talked about that, but there are many ways to do that. So we're almost at 20 minutes. Just a quick pitch for Ethos. We're one way to engage clients on the social and environmental impact of their portfolio. You can sign up for free, no credit card required, at ethos.so/advisors/signup. If you use your email from today's event, you'll have 30 days for free. So let me stop there and look at the questions in the chat. Let's see. All right, so I'm looking at not all ratings and scores are aligned with SDG from Emmanuel. Yes, so the SDGs, I would say, are not comprehensive. They cover what the UN and what countries around the world have defined as important global goals to meet by 2030. A variety of causes like humane treatment of animals or arts and culture or racial justice. Some of these are not directly aligned with SDGs. So the SDGs are a good framework for sure, but feel free to go beyond them if you'd like. From Amy, how do you see portfolio rebalancing happen due to ESG factors in the coming 3 to 5 years? So several of our current clients and a lot of advisors that I've talked to are seeing a lot of their clients moving partially to ESG. So anywhere from 5% to 25% to fewer are moving their entire portfolios to ESG. But I think that it is very likely that at least some of your clients will be interested in moving in steps to fuller or more complete ESG portfolios. It's an easier way to do that if they're currently in a non-ESG portfolio, move part of their portfolio, see how that does financially, and then if it performs okay, if they're happy with it, then you can move more of their portfolio to ESG focused. I do see that happening much more in the next 3 to 5 years. Neil, will the Descripta review change the way we look at biodiversity from a financial perspective, realize how much it is worth and therefore protect it more? Neil, I'm not sure what the Descripta review is, but I think that, or I hope that the UN conference at the end of 2021 and generally increasing attention on biodiversity will help us value it more accurately and put a higher value on projects that contribute to deforestation or contribute to mitigating deforestation, things like that. I'm hopeful that will happen, and as more people are aware of it, I think that it likely will happen over time. So going back to Emmanuel, one of your questions about social issues have taken so much backseat in the ESG. Can you share the data you have on social issues? Yeah, I totally agree that social issues have taken very much a backseat in ESG issues. Part of the cause, I think, is there is just much more readily available data on environment. It has been easier for companies, or there's been more demand to report on carbon emissions, toxic pollutants, waste, things like that. The data on social issues, so Ethos tracks this through a variety of ways. We do look at company reports, company filings. So companies are increasingly reporting on things like gender equality in their board and their employees, their diversity and inclusion metrics. Totally agree that has been not nearly as robust reporting. Ethos uses those company filings as well as third-party analyses. So a lot of these independent organizations like As You Sow, Just Capital, others will do analyses of, for example, racial justice or gender equality. So we'll try to incorporate independent analysis as well as government data, as well as company filings. And we do show all of that data transparently on our site. If you're curious, Emmanuel, we can talk more afterwards, or you should be able to find most of that on our site as well. Amy, so any suggestions on how to factor in the greenwashing into the overall ESG framework? Yeah, that's a great question. I think greenwashing is hard to root out. One good way to do it is to limit the amount of company self-reported data that you use in your analysis. So Ethos, for example, will use about 5 to 10% of our ratings will be directly from company filings. The rest will be from third-party independently verified data, government data, or our own analysis. That can be tough to do. So I would look for an aggregator or provider, Ethos or others, who do some separate analysis who will help to verify that this is not just company self-reported data. It's not it's not the greenwashing. It is hard to do, and it requires some diligence. Going back to one of your questions, Emmanuel, what do you think the impact of the new SEC climate change and ESG task force would have on ESG investments? The SEC, from what I know, they've started to review climate change reporting requirements. I don't see that being an immediate impact. I'm hopeful that within a few years that will be fully rolled out. And with the new administration in the US, I think that there is more momentum for that. in the near term, it's not going to have a big impact, but it could have a very large impact once it's rolled out. As I'm sure a lot of you are aware, the lack of standardization of reporting in the US, EU, elsewhere is a big challenge for any analysis of ESG performance. So any standardization of the SEC could have a huge impact. It would make it much easier to understand where there is greenwashing, where there isn't, and to do analyses of company reporting and to see which companies are, I guess, to compare company performance. Let me just type in, I'm going to type in our address here so you have our, it looks like Matt just typed our address. So yeah, www.ethos.so is our site. Ethos.so/advisors is our site for financial advisors. Amy, AI and ML is going hand in hand with ESG for greater impact. How do you see these technologies impact on ESG's future? Yeah, I think these are enabling technologies. They don't do anything by themselves, but definitely enabling of greater sustainability on things like manufacturing efficiency, supply chain logistics, so making or minimizing the amount of road time, for example, minimizing the amount of waste. So there's a lot of waste that happens in across industry, manufacturing, and production. I think AI and ML can really minimize that. So those are just a couple of examples, but yeah, if you're helping your clients invest for sustainability, describing how AI and ML can be complementary things to invest in, I think can be a good way to invest in things that maybe aren't directly low carbon or aren't clean energy, for example, but can still be positive investments for them and can still contribute to a more sustainable future. Emmanuel, I have a lot of concerns about the impact assessment from clients. Do you audit and evidence impact assessment data provided? Yeah, Emmanuel, so the impact assessment is clients saying, I care about X, Y, and Z. I care about climate change. I care about gender equality or other things. There's no personal information provided. It's that input from them that gives you a way to say, I know this lead or this client cares about these causes, and now I can design a better portfolio for them. I can communicate more information that's directly aligned with what they care about. If you want to chat about that offline, Emmanuel, we can definitely do that. I'd love to hear more what you're thinking there. Amy, I see US lagging behind Europe in terms of ESG adoption. Yeah, I'm not entirely sure what the reason is for that, Amy. I definitely agree. And I'm hopeful that this SEC review will start to change that. And I think the US is starting to catch up, but yeah, I'm not entirely sure what the reason is for the US lagging behind. Yeah, hopefully it's changing. I think that the EU generally is a little bit more progressive in terms of their political leanings and social leanings, and that's a very generalized statement, but it's one reason. All right, so I don't see any more questions. Thank you everyone for joining. Our URL is in the chat. Matt posted ethos.so. Please feel free to check us out and feel free to shoot me an email. Let me put my contact info up here. Please contact me at luke@ethos.so or yeah, feel free to call me. But I'd love to chat afterwards, and please check out Ethos. Thanks for joining today.